You really want to invest your hard-earned money, but Wall Street, well, it's incredibly intimidating. It's packed with confusing jargon, complicated charts, and fast-talking analysts. But mostly, there's that very real fear of putting all your cash into one single company, only to watch its stock price completely tank because of a bad earnings report. It kind of feels like gambling. But what if there was a simpler, way smarter way to invest? A way that basically automates your diversification? So here's our straightforward roadmap for today. First, what exactly is an ETF? Second, why do investors love them so much? Third, we'll explore different ETF flavors. Fourth, we need to understand the potential risks. And fifth, exactly how to buy an ETF. All right, section 1, what is an ETF? Let's cover the basics. ETF actually stands for Exchange Traded Fund. But let's just think of it using a metaphor we all understand. A basket, or maybe one of those variety packs at the grocery store. Instead of buying just one single candy bar, you buy the whole variety pack that has 50 different kinds inside. Well, an ETF works the exact same way. It's a single investment fund, but inside that fund is a highly diversified basket of many different assets, like stocks or bonds. You buy one share of the ETF and boom, you instantly own a tiny piece of dozens, hundreds, or even thousands of companies all at once. And just like the name implies, it trades on an exchange all day long, exactly like a regular stock. Let's really compare the two approaches here. Buying individual stocks carries super high risk simply because your financial success is entirely reliant on one single company's performance. You're literally putting all your eggs in one basket. If that company hits a rough patch, your whole portfolio suffers. ETFs, on the other hand, offer way lower risk because they spread your money across hundreds of companies instantly. It's the ultimate safety in numbers play. If one company in your ETF basket has a terrible quarter, well, you've got hundreds of other companies in that same basket that might be crushing it, which totally helps balance out the loss. Moving right along to section 2, why investors absolutely love ETFs. Let's look at the key benefits. The benefits of these things are honestly incredible for everyday investors. First up is that instant diversification we just talked about. You aren't just buying one single tech company. You could literally buy the entire tech sector with one click. Next, they offer extremely low management fees, which is absolutely crucial for keeping more of your own money. Third, unlike mutual funds, which actually only trade once a day after the market closes, ETFs are traded easily throughout the entire day. If the market's open, you can buy or sell. They're also super transparent. You can go online right now and see the exact companies held inside your ETF basket. And finally, they're incredibly accessible. You don't need $1 million to start. You can often get going for the price of just one single share. Now, I really want you to notice this shockingly low number, 0.03%. This represents what's called the expense ratio, basically the annual management fee for popular broad market ETFs, like the Vanguard S&P 500 ETF, ticker symbol VOO, or the iShares Core S&P 500 ETF, ticker symbol IVZ. To put that into plain English, if you invest $10,000, you are only paying $3 a year in fees. $3. Some actively managed mutual funds out there can charge 10 or even 20 times that amount. So keeping your expense ratios low means you get to keep thousands more of your own money compounding over time. It's a total no-brainer. Okay, section 3, exploring different ETF flavors to help find your strategy. Let's walk through a few examples of these different ETF flavors, just so you can see how to build a really balanced portfolio. If you want a broad market flavor that just holds the largest US companies, you might look at a ticker symbol like IVV or SPYM, which track the S&P 500. Or, hey, if you strongly believe in the future of technology and AI, there are tech-flavored ETFs out there like QQQM, which holds the top 100 non-financial companies on the NASDAQ. If you want some steady income, you could grab a dividend ETF like SCHD, which focuses on high-quality companies that actually pay out cash to their shareholders. And get this, ETFs aren't just for stocks. You can buy a bond ETF like BND for safe, stable debt, or even an alternative asset ETF like IIUM, which literally tracks the price of physical gold without you having to go hide metal bars under your mattress. And if you want the ultimate everything flavor, you can actually own the entire US stock market with just one single click. Seriously, an ETF like the Vanguard Total Stock Market ETF, ticker symbol VTI, holds a piece of thousands of American companies, large, medium, small, the whole shebang, all at once. For a lot of experts, a total market fund like this serves as the absolute perfect foundational basket for a beginner's portfolio. All right, shifting gears to section 4, understanding the potential risks and what you need to watch out for. So here is a really crucial point. you have to understand how these baskets are actually weighted. You see, most major broad market ETFs use something called market cap weighting. That just means the absolute biggest companies take up the biggest amount of space in your basket. Look at this breakdown of the S&P 500. The top 10 giants, these are massive tech names like Nvidia, Apple, Microsoft, they make up roughly 40% of the entire index. The other 490 companies, they make up the remaining 60%. So while you might think you're perfectly diversified across 500 different companies, a huge chunk of your money is actually highly concentrated in just a handful of tech megacaps. And that brings us to the specific risks you really need to watch out for. First up is just simple market risk. Look, broad diversification is great, but it doesn't magically eliminate overall market drops. If the whole US economy takes a hit and the index drops, your ETF is going to drop right along with it. Second is sector concentration. Like we just saw, a broad market fund right now has a really heavy reliance on technology companies specifically. And third, this is a sneaky one, a risk called overlap. This happens all the time when a beginner buys, say, an S&P 500 ETF and a technology ETF, thinking, hey, I'm diversifying. But because both of those ETFs are heavily dominated by the exact same mega-cap tech stocks, they're accidentally buying the same companies twice. They're concentrating their risk without even realizing it. Okay, final stretch. Section 5, how to actually buy an ETF in 5 simple steps. Let's look at an incredibly actionable 5-step roadmap directly from the experts over at Forbes. Step 1, open a brokerage account. There are tons of fantastic zero-commission online brokers out there today. Step 2, fund your account. Just link your bank and transfer over some cash. Step 3, use the search bar in your brand new brokerage app and type in the ETF's specific ticker symbol, like VOO or QQQM. Step 4, specify how many shares you want. Choose your order type, like a simple market order to buy at whatever the current price is, and just hit buy. And finally, step 5, monitor your investment. Now, you don't need to be checking this every single day, right? Just review your portfolio maybe once or twice a year to make sure your baskets still align with your long-term goals. As we wrap up this explainer, I really want you to take this away. You absolutely do not need to be a Wall Street insider to build real wealth. You don't need to sit there reading complicated earnings reports or try to guess which single company is going to be the next big thing. By using ETFs, you can just harness the overall long-term growth of the global economy through low-cost, highly diversified baskets. The tools are literally right at your fingertips right now. So, the only question left to answer is, which ETF flavor are